This is basically 30 years, Professor, after your original research. We're going to talk a lot about the new material. There's a lot of new material, but maybe the central premise in in days like today, years like 2022, is it still stocks for the long run?
Well, it's interesting because the first edition, which came on May 1994, used data through the end of 1992. And I looked back, and what was the long-term real return? As you know, it began at 1802 onward. It was 6.7% real, and then I updated it till June of this year, and it's 6.7% real, exactly the same. Last 30 years, despite all, the financial crisis, the COVID, the real return was 6.7% per year. It's remarkably durable. And then we also know it's remarkably volatile in the short run, but the durability of the equity or equity premium, as you might say, although then you have to subtract what you think about bonds, is really quite remarkable.
I think one of the big new chapters in the book, and the most important thing maybe arguably for the market this year, is the real rate on bonds. And so we talk about the equity risk premium. We'll talk about the historical equity risk premium, bonds, real rates. What are driving bonds lower for longer?
Yeah. Well, actually, there's 5 new. This is the biggest revision of all of them. It's also the most time between them. Have 5 new chapters, and one of them just on the interest rates and stock prices. And what I find, and others have found, although sometimes I don't know whether the Federal Reserve recognizes it, is how much of a drop in real interest rates. I'm not talking about ex post, I'm talking about ex ante, but I'm looking at TIPS bonds. As a global phenomenon, TIPS were floated in the United States in January of 1997 at 3.5% real. In 2000, they went almost to 4.5% real. And by the way, that was the real around the world. It was 4 to 5% real, ex ante. Until the latest tightening, they were all negative. They all dropped negative. And I'm talking about 10 years. This is not short term. And it's been steady. I ascribe it really to 4 different causes of the collapse of real yields around the world. One is slower growth. And that's composed of 2 things. First of all, slower population growth and slower productivity growth. This year, productivity has totally collapsed in a way that we've never seen before in the United States, actually. It's not discussed much, but the figures are almost unbelievable how bad productivity has been this year. But productivity is down, real growth is down, population growth is down. Listen, you do any, real rates follow growth. Take your Euler equation, and remember, it's the first derivatives are growth rates. So that's one of the factors. I also think there's increasing risk aversion. I think that may be due to the aging of the population. Becomes more risk averse. That holds wealth. Not too sure the magnitude on that, but I think that's certainly one of the factors. But one of the biggest factors, and again until this year, is the tremendous flip in the correlation between stock and bond returns. During the 50s, 60s, and 70s, even early 80s, the beta was positive of bond and stocks. Since really the 90s, it went to 0, and then it went negative. And that's, as you know, a negative beta asset is going to have a lower rate of return. And stocks treasuries are negative beta assets. They really are. Now, they're not this year. We'll talk about that. But and certainly they've correlated with stocks. But in the past, during all the crises, the financial crisis, treasuries were up. COVID crisis, treasuries were up. Whenever there's a shock to demand, and stocks go down, treasuries go up. Well, factor in a negative beta from a positive beta, and tell me what the return should do, and it goes down as it should. And that's a major factor. If you actually just take some of the raw betas and look at it, you can explain the 2 to 3 percentage points of the decline in real yields from that. So you have all these factors that are making for the decline in the real yields, and it's really quite persistent and quite worldwide.
So you started the year at negative 1% the 10-year tips. You're getting back to 1.
1 now.
And when you said tips started at 3.5, that was like the 200-year real return on bonds.
That was exactly it.
What is your expected return for bonds going forward? At 1% on the 10-year tips, where do you think we are?
Well, it's interesting because just before tips came out, because I had done stocks for the long run, I got a call from the media, and they said, Dr. Siegel, the Treasury's going to float tips. What do you think they're going to float at? I said, well, I guess 3.5%. That's their 150-year average. And indeed, they floated at 3.5%, and then continued to rise for the next 3.5 years. And then began, and by the way, again, mirrored, and we were actually late as a country coming to tips. Most other countries in the world had them, and even European countries did not have systematically high inflation. But the tips just then steadily, just down and down and down, 20, 30 basis points a day, a year, down to -1, -1.5 at one point. Actually, you can almost explain the whole decline in the stock market just by the rise in tips. I mean, if you think there's a 5%, 6% real equity premium and you raise the real rate by 2 percentage points, do the math. It's not that earnings have changed; it's that discount rate is really changed. But I think I think the real rate actually is going down. I think it's this tightening. The market thinks the Fed has got to produce a really strong real rate to stop the inflation. Now, the interesting thing about the real rate. Let's go to the short-term real rate. When we have the tips long-term real rate. So what is real rate going forward? Well, I mean, the treasuries are 3.5. The nominal treasuries are 3.5. So what do you think the average rate of inflation is going to be? If you think it's 2.5 to 3, you get, about 0.5% on that. I think it's actually short. It's my feeling actually that the short-term real rate, equilibrium short-term real rate, and I think is -1.5%. And it's gone down over the period. So you have a term structure on real rates. I think it's about minus. So what's really important about this is the Fed thinks it's plus 0.5%. So they think that they're gonna have to tighten a lot more to get a pinch on the economy. Where, I mean, I think they don't have to tighten as much as they think they do. I mean, in terms of getting that pinch on the economy. And I think if they tighten too much, they're going to really precipitate a recession. But that's just an interpretation. By the way, if you take a look at long-term Fed funds, what they think is the neutral rate, since they've been doing the dot plot, next week we're going to get the dot plot. I mean, if you go all the way back, when they started these 25 years ago, they thought for 2% inflation, the right Fed funds rate was 4.5%, which is a 2.5% real rate. Now they think it's half. So they themselves have realized, but I actually think that the real rate has dropped even more than what they think, and that does have consequences, obviously, for their tightening policy.
So if you haven't been following the professor's views, he came into this year the most hawkish on the street, calling for the most aggressive rate hikes. And coming back to behind the markets, we had Don Cohn, former Fed vice chair, in December when the market was saying 3 hikes. He was saying 8 hikes, way more aggressive. He's been spot on the whole Fed cycle. Now, there's a chapter in Stocks Long Run on the pandemic and the money supply. Jay Powell has said the money supply has not been predictable of inflation. You're the exact opposite view. What's he getting wrong? What is the story?
Oh boy, yeah. I mean, so I've been calling Jay Powell's monetary policy the third worst in the 110-year history of the Fed. I may actually raise it to the second worst, but we'll see what happens. The worst, of course, is the Great Depression, where we all know they let all the banks fail when they were actually formed to prevent exactly that from happening. It was absolutely incredulous to me. I mean, Craig knows. I mean, people at Wharton knew. I mean, I was when the pandemic hit and the money supply exploded. I said, "This is going to cause inflation." You've never seen that 25% M2 money supply increase. Milton Friedman did from 1870 onward. There has never been a money supply increase that fast, ever. And then in 2021, they increased by 12 or 13%. I said, this is just absolutely crazy. This is just going to produce a tremendous amount of inflation, and it did. I was definitely the hawkish. By the way, saying 8 increases, that's 2%. Well, now they're talking about 4% by year end. That's 16 increases, right? I remember when I called on CNBC back then for 3 or 4 increases. He said, "Oh my God, there'll never be." By the way, we're going to have a meeting next week. In the September 2021 meeting, this was their projection for this December's Fed funds rate. 16 FOMC members gave their opinion, as they're supposed to. 8 of the 16 said there is no increase for rates whatsoever this year. This was last September, when inflation was already heating up, speculation was rampant in all asset markets. 8 of the 16 said no increase. 5 said we'll need 125 basis point increase, and 3, the most hawkish, ventured that we might need 50 basis points by December of this year. Could you be more wrong than that? It's impossible to be more wrong than that. It amuses me when people are so, "Oh my God, the Fed is going to stay tight this long and this long," as if they know what they're doing, as if they have any concept of what they're going to do in 2023. Clearly in 2021, they had zero concept of what they were going to do this year. They just followed the data. But going back to your question, because I wrote an article back then saying how much inflation they have, and I was 4 years at the University of Chicago, my first teaching position. Last 4 years, Milton Friedman was there, and I, read all the monetary. And yeah, year to year, there's not a close relationship. But when you have 20% increase, 25%, and then follow it by 12, you take a look at the data, you're always going to have inflation, always. And he denied that there was going to be he said there's a relation between the two. And yes, that's true, and not on a year-by-year basis, but when you explode it, Friedman said to me, 18 to 24 months later, you explode the money supply, you're going to have that inflation. And what really upsets me so much about this policy is, okay, Jay Powell is not a monetary economist. He came from private equity factors, etc. Okay. Other FOMC members dissented. The staff gave very, "Oh yeah, there's not going to be inflation," and everyone bought it. I mean, it shocks me that lessons were not learned, and that maybe 1 or 2 of them said, "This is crazy." I mean, we all know. I mean, they were buying mortgage-backed securities in the biggest housing boom in history. By the way, housing boom in the last 2.5 years, in the Case-Shiller index, is greater than the boom preceded the financial crisis, to show you how rampant that was, and the Fed still felt compelled to buy billions of dollars of mortgage-backed securities. I mean, the policy that was followed was, in my opinion, inexcusable.
I think we hit the inflation topic.
No, okay, yeah, I'm just upset about it, guys. So, I am.
He gets fired up. He definitely gets fired up. So we talked about bond returns being below average.
Yeah.
We were at this conference a few years ago with Bob Shiller, and we had the CAPE discussion.
Yeah.
Talk about where you see our stocks. In the book, we talk about the CAPE ratio. At 4 months of the last 40 years, did the CAPE ratio have a prediction?
So the CAPE ratio is, we all know it's been overly bearish. There's several reasons. I talk a lot about it, and many of you know about my article in the FAJ where I said a CAPE ratio, a new look. I talked about the deficiency of the CAPE ratio. I talked about the deficiency of using reported earnings under the new FASB standards that way understated earnings and therefore, as a result, overstated the valuation of the market. I've also, and this is not just the first edition, I've talked about what I think the equilibrium, it's funny, I'd say 6.5%. 6.5%, the inverse of that is a 15 PE ratio, right? I actually think the right PE ratio for the market is 20 in equilibrium. And I do it not because the real interest rates are lower, although they are, and you could make an argument that way, unless you think it's just risk. If it's just an increase in risk aversion, then you wouldn't necessarily make that argument. But nonetheless, I've often made the argument that transaction costs for an index portfolio are basically zero now, and as a result, the equilibrium price of securities should be higher. Just to be more concrete, back in the 19th century, when you're getting 6.5%, you weren't getting 6.5%. You probably had a 1.5% of transactions costs just to try to keep a diversified portfolio. That's 5% real. 5% real is a 20 PE. So now you can, since indexation is costless, you can now really, you're just getting the same return. So really what's demanded is a 5% real. In a zero-cost world, that's a 20 PE of the market. It's certainly not a 15 PE of the market, which is a lot of people. That's another failure of the CAPE ratio is there's many failures of the CAPE ratio that I pointed out. That's just another one. There's also the buybacks and the earnings trend and all that. That's another issue. There's also something called the aggregation effect. I won't go into all these separately, but
Yeah. So,
that was at the Jacob Levy conference where we argued about whether stocks would still outperform bonds. Yeah.
there's a lot of talk on factors. Momentum is a factor that you get some coverage. You have a whole 4 new chapters on value and is value investing dead? Do you want to give an update on what you thought about the factors?
I expanded. I had one on value and size premiums. I've got 4 now, basically, on that. In bowing my head to John Cochran, I have a chapter called The Factor Zoo. And I talk about momentum and all the other factors. And one of the really, and you guys have been talking about this, I know, in the conference also, but one thing that I really found is how much things have changed since 2006. In other words, the last 15 years. Basically, the factor effect on virtually all of them has disappeared. There's been virtually no factor effect from 2006 onward. Now, I'm not saying that's true in every market in every single time period, but it is really stark what has happened. We all know what happened to value, and size haven't worked. Many of those related to the value didn't work, but even momentum, if you take it from, if you accumulate that factor, you see the graph and all that, basically it's level. Many others are trending downward. So a lot of things seem to change. I don't know why. I mean, it started, of course, the crash in value with the financial crisis and it hit the banks, and that really put them behind, and I don't know if it infiltrated into others. And then, of course, there's the big growth stocks. Now, we have had a resurrection this year, certainly in value stocks, but it's only honestly retraced half of what value stocks lost over the last 3 or 4 years. It has retraced some of it. I mean, there are some like Asna and everything. It's still one of the biggest gaps, and it's going to do that. But it just retraced approximately half of that. But it's really interesting in the pre-2006 strong factors, after 2006 not strong. I think the only one that maintained itself, and by the way, this was around the world, because I did the international factors too. Since 2006, not as strong as the United States, but around the world. Emerging markets is the only one that actually retained a lot of the factors. But there was a big market difference then.
So you talk about in the book, growth is not return as a concept. Is that, so given the Does the
Yeah.
15 years change anything for you?
No,
Do
it
you
didn't change. I had the big story, which I've used in several editions about IBM and Center of New Jersey. Had you bought them in before IBM became famous and did the computer and sort, had you bought them then and held them to the day, IBM had much faster revenue growth per share, earnings growth per share, and margins and every other factor that Wall Street did. Standard of New Jersey, now ExxonMobil, beat it in total return over the period. Valuation trumps growth in the long run. It also works with countries. This has been pointed out. I actually pointed out in the second edition. I expanded it. And then there have been articles. Jay Ritter wrote an article on it, and several others did. The country with the best stock returns of the last 120 years is South Africa. It's also had the slowest GDP growth of all the countries. The reason why it had the best returns is because it had the lowest valuations. So, I mean, it's you guys know this, but in the long run, the valuation just trumps the growth. In other words, growth stocks just become too expensive on average to support the fact their valuation. So I want to make that lesson clear so people know about that. Still occur.
Maybe we'll get one final question, then open up to the audience. So is that, in terms of allocation questions, U.S. is somewhat like the growth market, international is sort of like the value market is
Yeah, I mean, that's basically, what happened to Europe and the rest of the world where they were value stocks. I mean, when you talk about why did international underperform as much as it did. Now, Europe has special problems right now, but up till then, really, you could almost all explain it by just the value and growth phenomenon. Did you say VIX?
First part was the 60-40 portfolio.
Well, 60-40 portfolio, I mean, Jeremy and I, we've been working on 75-25 because the gap between stocks and bonds is just higher than average, much higher. So even with the extra volatility on stocks, short-run volatility on stocks, we've actually done simulations that show the probability of running out of money is actually less with a 75-25 portfolio than is with 60-40 under reasonable assumptions, forward-looking assumptions, real rates on stocks and bonds. 5% real on stocks, 0 on bonds. Now, bonds are 1. Stocks are probably 5.5 to 6 right now, in my opinion. In equilibrium, they're 5. So we feel on that. Let me say the following. When people said, I remember back 20 years ago, when people said, what we need is a security that matches the VIX. And I said, why do you want that? And they said, oh, because it has a negative beta and it'll stabilize our portfolio. And I said, don't you know what a VIX security will do over time? It'll keep on going down and down and down. And in fact, it did. It would probably, I think it went from 1 million to 10 or something like that, and a reverse split 25 times. So all they were doing, it was funny how people misunderstood. They went wild for this VIX, thinking it was a hedge. And they thought it was stable. They said, oh, VIX is 10 to 15. So it's stable, it doesn't deteriorate. And they, of course, didn't understand that the security kept on deteriorating. And they were doing really paying the put premium. We all know that. We all know the equivalence. You can do that. I don't know. I'm telling you that because that's what I remember about the VIX. Anyone else? Yes.
Recession, or could we catch a recession from China
and Europe.
Well, there's a lot of questions. So I've had two opinions on FedEx's problems. One said it's 60% macro, 40% FedEx. The other was 70% macro and 30% FedEx. They always, the 70% FedEx. They all gave most of the problem to FedEx. But, I mean, let me mention, because I mentioned this before, the biggest question today, which why did Jay Powell and the Fed never address in Jackson Hole, was how we could add 3.5 million workers to the workforce this year, as we have, through the payroll and the household, doesn't matter what you look at, and have negative GDP growth. I find it shocking, and yet no one has talked about it. So are we in a recession or not? Explain to me how that can happen. Is the data bad? Is it that bad? Or has productivity collapsed by an order of magnitude greater than it's ever collapsed before in the 75-year history that we've had it since 1947? Is that possible? And if so, why has that happened? Isn't that also worthy of thinking about if you're thinking about monetary policy? I don't hear a peep from anyone from the administration nor from the Fed about this. I don't know how you can run monetary policy without understanding this, because I clearly don't. If you look at the payroll report, we're clearly not in a recession. Look in GDP, we had 2 quarters of negative, and this quarter looks under 1. Well, today even, the Fed now went down to 0.5%, even with robust payroll, another unbelievable negative productivity growth after the 2 biggest productivity negative growths in history. I mean, what is happening to the U.S. economy? Is it collapsing, or are we just hiring people who are doing absolutely nothing? I think it's worthy of some explanation before you launch on, raising the real rate by more than ever before.
I think we have one more question, and then we have to wrap it up.
I was checking the Treasury bond rates. It says for about 1 year the return is 4%, and for the next 5 to 10 years it decreases and decreases even more further by 3.5, 3.4. So does that signify that the government is thirsty for the investment, but the rate of returns are so low for the future as well?
Well, let me just put one thing in your minds to think about forward. The way the CPI is constructed is so lagged and so imperfect that even though real estate prices are going down, yes, going down, you will see real estate and cost of housing, which is 43% of the core CPI, continue to rise for the next 18 months. It is that lagged. So if Chairman Powell is looking at the CPI, he's going to get a totally distorted view of inflation. Inflation, in my opinion, is very little going forward. I think we had a 12% inflation over last year if it was done properly, because we had a 40% increase in housing prices and 25% in rentals. Go look at the CPI. What will you find? 8%, because of the way they do it. So when you talk about what the real rates are, you have to talk about, well, what has inflation been and what is it going to be forward? By the official statistic, it's going to be much higher than what it is actually. Now, what it is actually is your true real rate. So keep that in mind when you think about going forward, what real rates are. They're much closer to the nominal rates than certainly the rate of inflation would make you think.
We are going to have to make that the last question, but if you want to keep update with the professor's weekly views on the market, behind the markets, Sirius 132, there's a podcast. Listen to Behind the Markets every week. Get professor's hot takes. first 10 minutes of the show every week. Thank you so much for coming here, Professor.
Thank you.
Thanks for having us.
Thank you very much. Enjoyed it. Thank you.